Hello everyone, very good evening to all. Welcome you all in the session of Oliveboard. Myself, Saloni Gupta. So yes, today we are here to discuss the startup finance. It is unit number 20 of module D. So in yesterday's class, we started our module D and we completed one unit that is hybrid finance. So today we have to start our unit number 20. So let's start startup finance. Before starting the startup finance, there is one important notice. Okay. So we are creating a mega webinar that is on 9th of February 2025. Okay. This year on 9th of February, we are creating a mega webinar and the timing for the webinar is 11 a.m. So here our experts, okay, they will discuss about the right way how to crack your GIB exam, how to crack your GIB exam in first attempt, okay, how to manage time, all the question and answer sessions, from where you can get all the notes, all the resources, because the resources, if you will get the right resources from our right faculties, then definitely you will going to clear your exam. So the strategies, okay, the guidelines, how to follow everything, okay, the exam pattern, analysis of paper. So everything they will going to discuss in this webinar and it will conduct on 9th of February and it is live and it is free of cost. So make sure you have registered yourself, okay. So please don't miss this opportunity. So everything will be discussed in this mega webinar. The agenda is over here as you can see the agenda. So module wise syllabus breakdown, all the step by step preparation strategy, best resources, how to get best resources, how to practice mock tests, how to manage your time, everything they will going to discuss on 9th of February and the time is 11 a.m. So let's start our session. So we are discussing about the startup finance. What is startup finance? See, the startup finance is it is basically included two words. The one is startup and the next is finance. So what is startup? Can anybody tell me what is startup? Tell me. So basically, startup is what it is a new business, okay, that is developed to sell its new type of product, new services, any innovation, any innovative product. It is basically made, okay, a new business that is created to develop and sell a new product, a new services. So startups are basically characterized by which by their high reward, high profit, okay, by their innovative products, by any kind of innovation, by having more and more, you can say, margin on the products. The business should be scalable, okay, it should have a good growth in the future. So then it is called a startup business. A new, a completely new model, okay, a completely new scalable business. If the business is scalable, then it has a high growth, okay, it will grow further. If the business is not scalable, so nobody will going to invest in any kind of startup if the business is not scalable. The business should have a scalable, okay, it should have a growth, it should grow at the fastest rate. Am I clear with the basic definition of startup? Clear? No. So what is startup? Again, startup is a newly established scalable business. Okay. And it has started in the very early stages of development. So it is in the early stage of development. So it also needs money, it needs fund, it needs all the resources, all the experience holders that may enter into the firm and they give guidance, they support. So startup is basically what a type of new business model who needs each and everything in the very early stage of its development. It is often characterized by the focus on innovation, on the scalability, and the potential for rapid growth. So it includes three things. One is innovation, second is scalability, and third is rapid growth. So again, if any business has any kind of unique product, any kind of unique services, so that business is known as a startup business which solves a specific problem. So what is the problem statement? Okay, what type of problem you will going to you can say solve in this scenario. If they have such kind of answers, then they will meet a good criteria of the business. So startups, they rely on funding from whom? From venture capitalists. In the coming units, we will be learning what is venture capital, what is private equity, okay, from angel investors, crowdfunding. What is crowdfunding? When you take the help of your relatives, okay, your family members, your siblings, your friends, okay. When you take funds from those people, then that is crowdfunding. Means all those people come together and they help you providing funds, that is known as crowdfunding. So angel investors are those investors who invest in high network individual, okay, high network worth individual. So they basically invest those business entities, okay, who has a high growth in future. This is important. Under DPIIT, okay, startup was established. What is DPIIT? That is Department for Promotion of Industry and Internal Trade. So under this department, startup was established to manage all the incentives, okay, disbursement, where to provide funds in which category for entirely a new business. This point is also important. The Startup India Hub, it is a what? It is an online portal that gives a variety of services to all the startups. India launched the project when in April 2016, and government started initiative for the Startup India when in January 2016. So after 3 months, okay, the you can say they have launched the project in 2016, the Startup India project. So these 2 points are very important. No. So what is the definition of startup in India? In from Indian perspective, what is the definition? So we have two types of definition. One definition was initial definition, means when the startup was recently made, okay, recently they were established. So what was the definition that time? Initial definition. And now the definition has been expanded to a certain limit. So initial definition and expanded definition. So in initial definition, so an entity shall be considered a startup. An entity will be considered a startup when they have fulfilled all these three criteria in initial definition. Up to 5 years from the date of its incorporation, when the company has been incorporated, registered, from that date to the 5 years. Okay, if they have done, okay, if they have completed their 5 years, then they will term as startup. If the entity's turnover for any of the financial year has not exceeded 25 crore, if the that turnover is not exceeded rupees 25 crore, it should be 25 crore or less than that, then it is called startup. If that business is working towards innovation, development, deployment, commercialization of new products, commercialization includes trade plus auxiliaries to trade. Auxiliaries means which help in making trade more successful. So these were the initial definition of startup. Now expanded definition, everything is same, just they have been more expanded. Now before it was 5 years, now it has become what, 10 years from the date of its incorporation. Before it should be not exceed more than 25 crores. Now it should not exceed more than 100 crore. That is the registration has not exceeded. And is as it is same. Done. The initial and expanded definition of startup India, it is important. It should. Yeah. So what are the benefits to startup under the startup plan? So when the startup has been created, so the startup owners, they get a few benefits. Okay, what are those benefits? First is tax incentives. Okay, government support them. They get tax incentives. They get tax rebate. There is tax exemptions on which category? On capital gains. So capital gain tax exemptions. Then they also get public procurement. Okay, proper treatment, priority treatment they get for startups in procuring funds. 3 to 5 year exclusion from any business inspection. So these startups basically they get, okay, from 3 to 5 years, till 3 to 5 years, no inspection will be done for this such type of business. No inspection, no examination will be done. Okay, government says, okay, you do work. Okay, I'm giving you 5 years, you do work. Okay, no inspection will be there, no examination will be there. Okay, in this 5 years, if you have done a tremendous work, then we will give you a startup theme. Okay, we will give say you that your business is now a startup. So when the incorporation has done after 3 to 5 years, the from inspection these startup has been excluded. Okay, no inspection is being done to these business. Next, 80% fee discount for patent registration. If any startup is related to patent, okay, patent registration, so 80% fee discount is given on the fee, and 50% fee rebate is given in which category? In trademark category. So these two are what? These two are intangible assets. So in intangible assets, the exemptions are given. Here now, so Atal Innovation Mission and Self-Employment Talent Utilization, that is SETU. Okay, so basically they have encouraged what an innovative and entrepreneurial culture. It has to develop Atal Innovation. Atal Innovation Mission and SETU program has been built. Okay, to encourage what innovative innovations for more and more production, for making innovative products, innovating services in the new start. This program purpose is to act as platform for the promotion of startup companies, for promoting startup companies because these companies are entirely new. So they also want that someone come and guide them. Okay, someone come and support them. Someone come and they give funds to these companies so that these companies may also develop more. So government basically what they do, they are focusing more on startup companies or more on MSME companies, micro, small and medium enterprise. So government is also working very hard towards these companies so that they may grow in future. So we have done the definition of startup definition in India, the basic introduction part, and what are the benefits under the startup plan. Now, next is funding. See, if any startup is there or if any kind of business is there, so definitely any business they need funds. They need funds to run their business. They need funds to operate their day-to-day transactions. So how, from where they can arrange the funds? Who are the people that will come and they will provide the funds to new startup, to new business? So funding is what? Funding refers to the money required what? To start and run a business. So definitely for running a business, for starting a new business, we need a lot of capital, we need a lot of funds. Now, we can arrange funds from crowdfunding, we can arrange funds from bootstrapping, we can arrange funds from angel investors, we can arrange funds from private equity venture capitalists. So these are the source from where we can arrange the funds if a business is entirely new. Now, it is a financial investment in a company for any kind of product development, manufacturing, expansion, okay, any kind of inventory. So for this purpose, okay, funds are required and every business they need funds to run their business for a day-to-day transactions. So if if a business is new, if there is startup, then what happens? Private equity comes, okay, venture capitalists they join the company, angel investors they come to the company, they help the company in giving the funds so that these companies may grow later. So once a certain amount of time has passed, so what was the certain amount of time we have discussed over here now in the initial definition? This one up to the 5 years from the date of incorporation and then expanded to the 10 years. So once the initial time has been passed and there is a proof of concept, that is POC, then they will provided the funding from whom? From venture capitalists, from angel investors, or from private equity. So these will come forward and they will provide the money to a startup. So it is essential to provide seed funding. So startups generally they get seed funding. Seed funding is what? Initial level funding. Seed funding is initial level funding to startups with an innovative idea, to conduct a proof of concept trials, to do pilot study, okay, to do a more to do exploration regarding new products. If the product has been launched in the market, to do the testing. So for all these things, funds are required and they get fund for all these purposes. Now, SISFS, this is what it is basically. It is a scheme that will provide the financial assistance for proof of concept, for prototype development, for product expansion, for pilot testing, for product examination, for product trials, for market entry, and for commercialization. So these are the things Okay, for this such purpose, the financial assistance is being provided by whom? SISFS, that is Seed Fund Scheme, Startup India Seed Fund Scheme. Clear? So this is again important. Tell me, any doubt to anyone till over here? Then only we will move forward. Okay, please do write in the comment section box if you have any doubt. Can we move forward? Now, now what are the types of startup financing? So one is debt financing. Okay, the startups will arrange funds from where they can arrange funds from debt financing. That is, they can arrange funds from taking loans from the bank, loans from any financial institutions. And if they have taken the loan, then certainly they have to pay what? They have to pay interest. Now, equity financing, okay, they can take equity financing later on. These equities they will get, okay, in terms of dividend they will get the funds. Then for grant, if government provide grants to such you can say institutions, that is non-repayable funds offered by government, foundations or organization to support specific project. So why they are non-repayable funds? That is government basically they are also working very hard, okay, to providing funds to these startups, okay, so that they may grow in a very rapidly. So that is a government also provide grants basically in the field of technology, in the field of social impact, in the field of R&D. Clear? So for all these purpose government provide funds to these startups. Stages of startups and sources of funding. Now, what are the stages of startup? So in startups also we have different stages. Okay, one is idea stage, one is phase stage, one is seed stage, one is more you can say series A stage. So we have different stage. That is moving from top to bottom. First is idea phase. Now, what is this idea phase? Suppose you have thought, okay, to invent this product in the market. Now you have only thought, you have made thought in your brain. Clear? You have not worked on it, okay. Your that product is still in the progress, that is not made completely. You have thought, you are working little bit on it, but the product is entirely not, it is being completed. So that is what known as idea phase. So entrepreneur has the business concept in their head only and working to turn it into a reality. Only the product is in the head, okay, it is not being completely made. At this point, the quantity of money that is required is relatively low. So definitely, if you have only idea and if you want to make that idea finalized, if you want to make that idea, okay, to build into a reality, then you need a little bit. Okay, at that time, at idea phase, you need relatively low funds. So growing a company using only one's own resources and refusing any outside investment is an example of bootstrapping. If your if your product is in the idea phase, then it is important that you will take the help of bootstrapping. Now, what is bootstrapping? Bootstrapping is taking the help of your own money, okay, your own self money, your self earnings. That is what bootstrapping. So because it is in the idea phase, once the product is being made, okay, it is in the process, then you can take the funds. But you have just only thought in your brain and you want initial capital, then you can take the help of bootstrapping. Your own money, your savings. In a very easy language, bootstrapping is what? Your savings. Done. Now, next comes seed stage. Seed stage is what? When the company is required to carry out field trials, test the product. Okay, product is made, product has been completely made. Okay, now it's time to test the product on different clients, on different consumers. So for such type of thing, you want a seed stage funding. Now, angel investors and private individuals, they put money into the high potential enterprises. At this point, it is possible to raise funds through a method called crowdfunding. Angel investors and private equity, they will put their money when the product is when they see that the product has very high potential. Okay, they have very high potential to reach the market, to reach in the customer's mind. But at this point, at the seed stage, what is more, you can say, possible to raise funds through a method called known as crowdfunding. Now, what is this crowdfunding? If you if you take the if you take funds from your relatives, okay, from your friends, from your family members, from your siblings, from your elders, from your juniors, seniors, okay, from your peer members, that is known as crowd. Clear? I hope this is clear to you. Now, next is series A stage. So at this stage, you need a money high. Okay, your product has been developed. Okay, company has developed its product offerings, and now the company wants to extend this product to other markets. Expand this product to different regions, geographical regions. So for that, they need a series A stage funds. Funding generally it comes from venture capitalists. Okay, they have large ticket size. Private equities. Okay, they invest in private companies only, no public companies, only private companies. Or if any public company is there, so they will delist the public company, then they will provide funding from venture capitalists and from equity owners. Now, when the market responses has already been validated, it is best to approach venture capital firm. So when the product has completely made, okay, now it's time to expand your product. Okay, now it's time to make your product very famous in the market. So it is that time when the venture capitalists they will come. Okay, they will make any kind of improvements in the product. Okay, they will launch your product to many other different countries, different regions. So they will come and they will provide funds in that. Now, so what is exit options? Again, if any venture capitalist, if private equities, if they will join your company, okay, they will improve your company's product, they will improve your company's internal matter, any kind of improvements, any kind of funds you require, they will provide you. So what they will ask in return, they will ask the ownership of your company. Now, how they will going to take the ownership of your company? Okay, your your company will, okay, suppose ABC Limited is a company. ABC Limited company wants funds for expanding its market. Now ABC company will sell the shares to private venture capitalists. Venture capitalists in in return of the shares, venture capitalists will provide funds to ABC Limited, and they will take the part of the ownership of the company. Now, when all the settlement has been done, when the company makes a huge profit, okay, after that, these venture capitalists they will sell the shares of the company to another company, and in this way, they will make a huge profit. So this is how they take a exit mode. So they join the company, okay. They work in the company, they do further improvements in the company, and then they make a huge profit from that company and they take a exit mode. So this is how they work in the company. So it is possible that the investors will come to the conclusion that they want to sell the portfolio firm to another company. Portfolio firm means your shares, okay, companies shares, companies, you can say the internal shares of the companies to another company currently operating in the market. This is how they take the exit options. So either they will sell the company's share through IPO. Okay, they will sell the company's share to another company. Okay, so they leverage to buy out all these things. Okay, they will do and they will take exit move. And after that, they will join another new company. So this is how they work for different companies. So what we have done, we have seen the stages of startups. So basically, idea stage, seed stage. Okay, till here is the stages of startup. Now, how fundings is being required and what is the exit option for venture capitalists? This is from this to that. And rest what we have seen types of startup financing, how funding is being done, benefits to startup under startup plan. So all these things we have completed. Main things we all have done in the startup finance. If you have any doubt, you can comment down. You can ask any kind of queries if you have. So again, tomorrow we have no class. So day after tomorrow we will start with our another new unit. After startup, we have done hybrid finance, we have done startup finance. Then next is the private equity and venture capitalist. So this is very important unit. So next we will going to complete this particular unit. So yes, thanks for watching the session. I hope you have enjoyed the session. So till then, take care everyone. Goodbye and keep studying, keep watching.